let's talk about the inflation risk in APAC. It's not that much of a risk in China and some of the other markets like Indonesia and Thailand. But in India, you're saying that the problem can be quite worrisome, but something that the RBI cannot address by raising rates. What does that really mean for India's economic outlook?
Well, it's a difficult one. And so if you make a comparison, say, between the big argument or the big discussion people are having about developed markets like the United States, for example, where you're seeing really high inflation rates there, rates that you haven't seen for 30 plus years. It's a very, very different environment. So in the US, it's really all about demand. And you've got, as the reopening continues, this bottleneck of trying to get supply to meet that demand. In India, it's very much more a supply than a demand story. Earlier on, you had the impact of the pandemic pushing up prices rather than leading them to fall as they did in many domestic economies. You don't even have that nice base effect to really compare with as we move through 2021. But also recent rains, floods likely to impact again on the supply side, pushing up prices, in particular across Asia, India in particular. The food component of the CPI basket is very, very much more important than it is for developed markets. So temporary effect, and they're likely to drift back again, as we're seeing in countries like the Philippines, where the inflation rate's down to only just above the target range, now 4.1%, likely to fall further, even further over the coming months. But it's a very different circumstance. You can't really do a lot about, rising food prices by putting up rates. And it's just something that the central banks, including the RBI, just won't be doing.
Yeah, and that seems to be the common view on the street. Rob, how does Asia then react to all the tightening and tapering talk in the US by the Fed?
Well, it worries. Well, it should worry because that's potentially one of the worst environments that you could get if you are actually moving towards a Fed that's going to be tightening quite a lot and over quite a prolonged period, and you combine that with quite a lot of dollar strength, and that's not a particularly favorable backdrop, especially for EM Asia. But of course, the Fed is playing this extremely cautiously. So that fear of the Fed raising rates to the extent that they were perhaps in 2018, the last time we were in a tightening cycle, just isn't there. The peak Fed funds rate, if you look at the OIS dollar implied yields, it barely rises above 1%, and that's 10 years out. So there's really very little concern at the moment that the Fed is going to do very much more than perhaps a couple of hikes over the next 3 to 4 years. The question is whether or not that view is right. And if that changes, if the inflation appears to be higher and perhaps more persistent, then that could change and that could put Asia back under some weakening pressure.